I've already paid all the interest, so I don't want to pay my mortgage off because I've already paid all the interest up front. No, you didn't. You only pay interest on what's outstanding. And once you've paid on a mortgage for years and years and years and you've paid the principal down, your payment is still the same. Much, much more of your payment goes towards principal after 15 years in a 30-year mortgage than in the 28th year of a 30-year mortgage.
Look at your house. For most of us, it's the biggest purchase we will ever make. It's the American dream, right? Walls that hold our memories, a backyard for the kids, a symbol that we've made it. But what if I told you that for most people, that dream is actually a 30-year nightmare of debt? What if I told you that on your $300,000 home, you're on track to give the bank another $200,000, $300,000, or even $400,000 in pure interest? You're not buying one house, you're buying two. You just only get to live in one of them. It's not your fault. Let's be honest. The school system taught you about the Pythagorean theorem, but not how a mortgage amortization schedule secretly robs you of your future wealth. You were handed a stack of papers thicker than a phone book, filled with jargon designed to confuse you, and told to just sign on the dotted line. You've been playing a game where the other team wrote the rules, and you were never even told how to keep score. But that ends today. The secret to breaking free isn't some complicated financial gimmick. It's not about making $1 million salary. It's about understanding one simple truth and asking one single question. A question so powerful, it fundamentally changes your relationship with the bank and can literally save you tens, if not hundreds of thousands of dollars. Today, I'm giving you Dave Ramsey's #1 mortgage question. I'm going to break down the simple math behind it, show you exactly how it works, and give you the confidence to take back control of your single biggest expense. So here's the challenge. If you're okay with just renting your home from the bank for the next 30 years, then this video isn't for you. Go ahead and click away. But if you're serious about owning your home outright, if you're ready to stop making the banks rich and start building your own wealth, then you're in the right place. Don't move a muscle. Now, let's get practical. Knowing the question is one thing, actually getting your money to the right place is another. You have to be your own advocate because, believe me, your bank's website is not always designed to make this easy for you. Think of it like this. You're sending a care package to a soldier. If you just write the Army on the box, it ends up in a massive warehouse and might never get to your person. But if you write their specific name, rank, and unit on it, it gets directly into their hands. Your extra payment is that care package. If you just hit the generic Make a Payment button online, it's going to that giant warehouse. The bank will often just hold it in what they call an unapplied balance account and use it for your next month's regular payment. You save nothing. You have to write the specific address on the box. That means looking for a checkbox that says Apply to Principal or Principal Curtailment, or a separate field that says Additional Principal. If you don't see one, you can't just hope for the best. You have to pick up the phone. Let me tell you about a guy named Daniel. Daniel works in logistics. He's a sharp guy. He was fired up after hearing this advice and decided to throw an extra $1,000 he got from a bonus directly at his mortgage. He went online, put $1,000 in the payment box, and hit submit. He felt proud. He was taking control. A month later, his new mortgage statement came. He looked at it and his stomach dropped. The $1,000 was just sitting there as a credit. His principal balance was almost exactly the same. The bank had just put his care package in the general mailroom, planning to use it for his next scheduled shipment. He saved $0 in interest. Daniel had to spend 45 minutes on the phone with a customer service representative, arguing with them to get his money applied correctly. It was frustrating, but it was a lesson he never forgot. From that day on, he always double-checked, always made sure he was putting the specific address on the box.
Every time you pay principal, that makes your next payment, more of it go towards principal, less towards interest.
So if, say, for example, I was gifted $1,000 for, I don't know, just being amazing, and we went and put that on the principal.
Yes.
Would that change our payment the next month?
No, your payment stays the same. It changes the amount of interest would go down because you're going to be charged interest on $1,000 less. You're not paying interest on that $1,000 anymore. Okay. And so it would cause your payment would stay exactly the same, but more of your payment would go towards principal.
Oh, okay.
Because you don't have as high an interest charge because you don't have as high a balance. Your interest is calculated on the balance each month. You pay your interest rate only on what's outstanding.
Don't let a poorly designed website or a lazy bank employee steal your momentum. You are the master of your money, and you have to command every single dollar to go exactly where you want it to go. Now, there's one more critical piece to this puzzle. It's the part that requires patience. It's the part that separates the people who succeed from those who try, fail, and give up. It's understanding when to start this attack. Dave Ramsey's plan is built on steps for a reason, and attacking your mortgage with intensity happens in baby step 6. Not baby step 2, not baby step 3.
Throwing money at the mortgage early and often when you get to baby step 6 is so important.
Think of your financial life like you're building a fortress. What's the first thing you do? You don't start building the giant 30-foot high outer wall. No. First, you dig the foundation and pour the concrete. That's your $1,000 starter emergency fund. Then, you have to clear the battlefield of all the little enemies right outside your gates. That's your debt snowball, killing off your credit cards, car loans, and student loans. After the immediate area is secure, you build your main barracks and stock your armory. That's building your fully funded 3 to 6 month emergency fund in baby step 3. Only when your fortress is secure, when you have a moat of cash to protect you from unexpected attacks, do you start building that massive outer wall, paying off the house. Trying to do it out of order is financial suicide. Let's talk about Emily. Emily is a school teacher, and she's a go-getter. The moment she heard about the power of paying off a mortgage early, she got obsessed. She started throwing every spare $50 or $100 she had at her mortgage, using the principal-only method. She was so proud watching that balance tick down. But she hadn't finished the other steps. She still had a $15,000 car loan, and she only had about $500 in her savings account. Then it happened. The transmission on her car went out. The mechanic gave her the bad news. It was a $4,000 repair. Emily had no emergency fund. The money that should have been in her fortress's armory was already spent on the outer wall. She had no choice. She had to put the entire $4,000 repair on a credit card with a 21% interest rate. Look at the math. She was so focused on saving 6% on her mortgage that she ended up in a new hole, paying 21% on a brand new debt. She took one step forward and 3 giant steps back. The stress was crushing. Securing your financial foundation first isn't a suggestion. It's a requirement. It gives you the power and the stability to attack your mortgage with incredible force without ever having to look over your shoulder in fear of a blown transmission or a leaky roof. So let's bring it all together. This isn't complicated. This is about taking back control. It starts with one simple question. How can I ensure this extra money goes 100% to the principal? We talked about how your mortgage is a monster that grows with interest, and how principal-only payments are the only way to land a direct hit. We talked about how you have to be your own advocate, making sure every single extra dollar is addressed specifically to principal, so the bank doesn't just put it in a holding account. And we talked about the critical importance of timing, of building your fortress in the right order, so that you can attack your mortgage from a position of strength, not desperation. Here's what I want you to burn into your brain. Your income is not what will make you wealthy. Your habits will. Your choices will. A person making $50,000 a year who masters these principles will be light years ahead of a person making $150,000 who just lets their money drift away month after month, year after year. You have the power to change your family's financial future, starting right now. So here is my challenge to you. I'm not going to ask you to like this video or subscribe to the channel. I'm going to ask you to do something real. Your one step for today is this. When this video is over, I want you to go find your most recent mortgage statement, either the paper copy from the mail or log into the website. I want you to find one number, the current principal balance. I want you to write that number down on a piece of paper and stick it on your refrigerator, on your bathroom mirror, somewhere you will see it every single day. That number is your enemy. That is the monster you need to defeat. It's not just a bill, monster you need to defeat. It's the single biggest thing standing between you and true financial freedom. Stare it down, get angry at it, and then make a plan to destroy it. That's your first step. Go do it.